Here's a question worth asking. If Parikh, one of the India's most trusted long-term firms, doesn't keep all its money in India, then why do most investors do exactly that? Now, this is a fund that avoided big losses when markets cracked. A fund that basically didn't chase fads. A fund that people trust with their retirement money, and yet almost one third of its portfolio sits outside of the country. Now, that is not an accident. That's a structural choice that this fund has made. Today's video is not about convincing you to invest globally, it's about understanding why professionals already do and what they know about risk that most portfolios ignore. Chapter 1: The philosophy behind the fund. To understand this decision, you first need to understand what kind of fund this is. Parikh Long Term Equity Fund, now known as the Parikh Flexi Cap Fund, was never built to win every year. It was built to survive every cycle from the very beginning. The focus was simple: protect capital first, compound patiently, and avoid permanent loss. Now, that philosophy shows up everywhere in the portfolio. Fewer stocks, long holding periods, businesses chosen for durability, not excitement. There is no urgency to act, no pressure to watch short term benchmarks, no assumption that the Indian market will always be the best place to deploy capital. Now, this is important because most funds start with a country first mindset by following narratives like India is growing, India will outperform, or India is the opportunity. Now, Parikh started with a different question. What is the best risk adjusted opportunity right now? And they were willing to accept an uncomfortable truth. Sometimes the answer is not India, and that does not mean pessimism about the Indian economy. It means humility about markets. The global allocation you see today is not a technical move, it is basically a reflection of this philosophy. A belief that good businesses exist everywhere and that long term investing works best when capital is allowed to move freely without emotional or geographical bias. Once you see the fund that way, the 30% allocation stops looking unusual, it starts looking inevitable. Chapter 2: What happens when a fund becomes too successful? Now, success creates a problem most investors never notice. When a fund performs well across cycles, money doesn't arrive politely, it floods in. Monthly SIPs, lump sums, now investors chasing consistency on paper. This looks like validation. In reality, it introduces friction because the capital needs places to go. In a market like India, depth is limited. There are only so many high quality businesses with enough liquidity to absorb large amounts of money without distorting prices. As AUM grows, fund managers faces a quiet trade-off. Either dilute conviction by buying more marginal ideas or crowd into the same large names everyone else owns. Now, neither option is actually attractive. This is where most funds compromise. They start owning the market instead of selecting from it. Returns slowly converge towards the index, even if the philosophy stays the same on paper. Parikh chose a different escape route. Instead of forcing more money into the same domestic opportunity, they basically expanded the field itself. Not by changing their style, but by changing the geography. The global markets offered them the depth, liquidity, and access to businesses that could absorb capital without compromising valuation discipline. Now, this decision solves a structural problem. It allows the fund to remain selective even as it grows. It protects existing investors from performance drag caused by size. The global allocation, in that sense, is not about chasing opportunity, it is more about preserving the standard. When you look at it this way, overseas exposures stop being a return enhancer, it becomes a pressure wall. A way to stay true to the original philosophy even when success tries to push you away from it. Chapter 3: Why global markets solve the constraint better than anything else. Now, at this point, the question becomes obvious. If scale is the problem, why not just adjust within India? Why not move across sectors? Why not hold more cash? Why not rotate cycles more aggressively? Because all of these are eventually temporary solutions. Cash is a timing call. Sector rotation assumes you can predict cycles. Style shifts introduce new risks the fund never was designed to take. A global market solves that problem structurally. They offer the enhanced depth that the domestic market simply cannot. More listed companies, higher liquidity, entire industry do not exist in India's public markets. Now, this matters when you're managing serious capital. A fund can deploy large amounts of money without distorting prices. It can stay patient on valuation. It can wait for quality instead of compromising to stay fully invested. For Parikh, this was never about finding the next hot geography. It was more about expanding the opportunity set without changing the behavior of the fund. The same filters apply: strong balance sheets, durable business models, capable management, and reasonable valuations. The only difference, although, is the location. And that distinction is critical because this approach avoids a common investor trap, confusing diversification with prediction. The fund is trying to guess whether India or the US will outperform next year. It is acknowledging something far more practical. No single market deserves a permanent monopoly on your capital. By allowing capital to move where risk adjusted opportunities are better, the fund protects itself from forced decisions. It avoids overpaying during domestic euphoria, and it avoids shrinking its universe when India goes through lean phases. At scale, flexibility is not a luxury, it is survival. And global exposure is the cleanest way to preserve that flexibility without breaking discipline. Chapter 4: Risk is not volatility, risk is concentration. Now, most investors misunderstand risk. They think risk is basically a daily movement, red screens, sharp falls, and short term discomfort. Now, that is not risk, that is just noise. Real risk shows up when everything you own is exposed to the same outcome. Same economy, same policy environment, same market mood. Now, that is concentration risk. When a portfolio is entirely tied to one country, it doesn't matter how many funds or stocks you hold. In a bad phase, the corrections rise, everything moves together. This is where global exposure quietly changes that equation forever. Different markets respond to different forces. Interest rates are different, innovation cycles are different, consumer behavior is different, and so are the capital flows. They do not peak, rise, or fall at the same time. So when one market struggles, another one can simply be flat or declining less or recovering sooner or be in a bull run. So that gap actually matters. It reduces drawdowns, it shortens recovery time, gives you more money for your asset allocation, it prevents permanent damage or to compounding, and that is why global allocation exists alongside domestic holdings, not instead of them. By reducing concentration, the portfolio reduces the likelihood of emotional mistakes, and that is risk management in its purest form. Not control, not prediction, just intelligent positioning across different economic realities. Chapter 5: What the last market cycles actually proved. The structure discussed is easy to appreciate in theory. It matters only if it holds up when markets misbehave. Over the last few cycles, the test has already played out. When Indian markets corrected sharply, the portfolio did not fall in line with the index. Losses were contained, recovery was quicker, not because the fund avoided equities, but because not all equities in the fund were reacting to the same shock. During domestic stress periods, global holdings often moved differently. Sometimes they declined less, sometimes they stayed resilient, and in a few cases they even gained while India corrected. That divergence did the heavy lifting. And then came phases where global markets struggled while India held up better. In those periods, the domestic allocation absorbed the pressure. The portfolio did not collapse just because one geography was out of favor. The back and forth is exactly the point. Not part of the portfolio is expected to perform all the time. Each part exists to support the other when the conditions change. That consistency is what allowed the fund to protect capital during bad markets and still participate meaningfully in good ones. And this is the difference between chasing returns and engineering outcomes. The global allocation did not make the fund exciting every year, it made the fund dependable on every cycle. And that distinction matters far more than most investors realize. Chapter 6: What this means for Indian investors. Now, most Indian investors believe that they are diversified. They own multiple funds, different categories, sometimes even different styles of investing. But almost all of it depends on the same thing: India is doing well. Now, that assumption often goes unnoticed because it has worked for long stretches. But it is still an assumption. What this fund demonstrates is a quieter way to think about diversification. Not as a checklist, but as an exposure to different economic realities, different interest rate cycles, consumption patterns, innovation engines, and different policy risk. The purpose is not to dilute belief in India's growth story. India remains a strong long-term opportunity. Purpose is to accept that no single country deserves 100% confidence all time. For Indian investors, this matters more than it appears. Our careers, our incomes, our properties, and our future liabilities are already tied to India. Adding global exposure is not access risk. It adds balance, and this is why professional allocators think globally by default now. Not because foreign markets always win, but because portfolios survive better when outcomes are not dependent on one system behaving perfectly. The lesson here is not to copy a fund, it is to copy a way of thinking. Build portfolios that can function across environments, Now, that doesn't need constant intervention. That allows time and compounding to do the heavy lifting. Once you internalize this, diversification stops feeling optional, it starts feeling structural. Once you see it clearly, the idea becomes hard to ignore. Good portfolios are not built on confidence alone, they are built on adaptability. What this fund demonstrates is not superior forecasting, it demonstrates structural humility and acceptance that markets rotate, that leadership changes, that no single country, however strong its story, should carry the full weight of the long term capital. So, this is it, guys. I hope you understood the importance of global investing and global diversification through this context, because if India is one of the best performing funds, where India's most capital is actually sitting in terms of mutual funds, is diversifying globally, then should you not? So ask your financial advisor or your fund manager today, what are they doing to take the best care of your capital? Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.